Thanks for tuning in to Where Do Millionaires Invest? The principal reason why all of us turn to investing is because we want to grow our status from being a rich person or from being not a very rich person to a rich person, from a rich person to a millionaire, from a millionaire to a multimillionaire. One way to do this is to try and imbibe the best practices of investing, and by watching and understanding what the rich of India are doing, or if you can't do that, to try and understand what the wealth managers who advise these rich are telling them to do. This is what we aim to get via the series of the next 7 or 8 episodes. Get in the wealth managers who advise the richest families in India about where should they put their money. Thanks for tuning in once again to Where the Millionaires Invest.
We at Edelweiss Wealth advise close to 2 lakh crores of wealth assets, and this is spread across ultra HNIs, family offices, corporate treasuries, and a lot of CXOs, who have ESOPs, etc. So we have a very wide variety of clientele, which includes, absolutely the top end of the, the uber rich in India, to the CXOs, which also are working in companies, etc. Basically, our criteria has been, as I had mentioned, around 5 million and above in investable net worth.
So you heard Alok Saigal talk about why is it that Edelweiss Wealth is a serious player. Let me try and start this series by asking him the same question again. Alok, great having you on the show. Thank you so much for joining in.
Thank you, Neeraj. It's my pleasure entirely.
No, so this is the inaugural episode. Let's set the base. What is it that Edelweiss Wealth particularly does, or what does the wealth management industry particularly do, and what are the set of clients that you typically have?
So in a very, very basic terms, we manage money for the rich. That is what we do. But just to give you a slightly more nuanced answer, we are managing money for the ultra HNIs, family offices, and basically anybody who has a surplus of 5 million and above is our customer. And that is how we define the client, but it goes all the way up. We as a firm have obviously specialized in the higher end of the curve much more, because if you see the industry, people have specialized. You have the bank-led wealth managers, which are more in the mass affluent and the HNI space. And then you have some of the non-bank-led players who are specialized in the mid segment, and there are some who have specialized in the ultra-rich. So we are of the type who have specialized more in the mid to ultra-rich variety and catering to their needs. So that's the spectrum that we cater to.
Okay.
Yeah.
So when you think of asset allocation for these clients, how do you go about thinking about it? Simply because, this is different, right? This client probably has a strong opinion herself or himself.
Absolutely. So there are 2 ways to look at asset allocation with these sort of clients. And one is, the standard asset allocation, and I'll come to that, which is, how much debt and how much equity. But for this set of clients, what we also do is something more nuanced. And that is that we do a need-based asset allocation. So the idea is that what does the client need to do with this money? Because obviously it's not to meet his day-to-day requirements. He has enough and more of this surplus. So what we try and bucket it is that, we've created a sort of a framework, and I'll just share that framework. One is what we call, the lifestyle needs. And typically that may include art, philanthropy, his day-to-day, running the house, and, travel, and because these are all big components for them. But the idea is that none of this should come from the capital. The idea is that this comes from the portfolio. So we create a portfolio, and this cash flow, so it's basically a reverse, that what you need to spend in the year, and it depends on, type of the client. And this number can be very, very different, including luxury cars or, luxury villas and all that stuff. But ultimately, we do not want them to dip into their core capital. And therefore, the cash flow has to come from the portfolio. And that is, I think, a very different thinking that we try and bring to the table. The second is, a lot of these guys want to invest in growth companies. And it's a serious, investment. So in terms of, either incubating new ideas, or a lot of times they want to invest in technologies related to their existing business. So just to give an example, if somebody is in the automotive business, from their family office, they may want to seed certain automotive technology companies. A lot of guys who are in healthcare, they actually want to invest in new technologies in healthcare, but a lot of times that is either done from their incubation centers in the companies, but a lot of times from the family offices. And a lot of it is also in new age startups, etc., etc. So that is what we call the growth portfolio. The third is what we call the boring or the standard portfolio, which is where we say you do nothing fancy. This is a place where you just invest for the long term, thinking in a moderate manner. And the fourth is what we call a safety net or a sinking fund. When markets go through extreme bouts of turmoil or people may suffer, some risks in their business, they should have a safety net, is what we say. So this is a core basic philosophy that you look at lifestyle, you look at your growth, look at a treasury or a moderate portfolio, and your safety net. This is how we start the basic bucketing of the needs. And it also couples with next generation planning, next generation thinking, how much they want to keep for their succession. A lot of times for children, a lot of times children want to incubate new businesses. Are you keeping money aside for that? So I think the asset allocation is an output of first getting this input done, and then you invest according to that. And that is how it is possibly different from the regular asset allocation, because this sits on the top of asset allocation, and then you come to the asset allocation, because each portfolio, the asset allocation will be different,
right,
for and this will be different for each client as well.
Of course. Yeah, but on average, does safety play a larger part than growth typically?
Again, depends on where the client is in his journey. So to again give a context, if somebody has sold his business, the person may be in his 50s or late 50s, but his children are all 27 to 30-year-old. So in that, they will create a safety net, but beyond that, they want to take risk, because the children want to invest in a particular manner. And what we are also seeing, that as the wealth is moving from one generation to the other. And I'll just give a back context here. In India, it's not so much that wealth is multi-generational. You have these old traditional business families, but you have 100, 200 of those. But a lot of the money that is getting generated is a lot of the businesses that started 20, 25 years ago. A lot of in manufacturing, say pipes, cement, mid markets, a lot of these, and then obviously the new age IT or the digital boom that has come. Now, a lot of these people who have come into money are first generation.
Sure.
They may be, and I'm just keeping the new age aside, then the age group is between 45 to 60.
Okay.
And that's when they've come into money. And I can give examples of a lot of listed companies today, or some of the companies which have done stake sales, and all the promoters are in this age group.
Sure.
And the children are in the age group of 25 to 40. Now for that generation, which is now moved, but the money is moved from generation 1 to generation 2. And imagine a scenario where generation 1 has worked very hard, built the business, and generation 2 either has to build a new business or is only managing this money, which is itself a very important and a big task. Therefore, the outlook has changed, and therefore this need for the wide spectrum. Like, to give a sense, and I don't want to preempt this, but international as a theme. 5 years ago, if you ask any Indian, international, why are you not investing in international? They'll say, how does it matter? I don't want to do. But today, if you ask them, because the children are all foreign educated, they possibly have a house abroad, they want to spend some time abroad, they want to do international investing. Also, the fact that they realize that their entire money is in a single asset class, and that asset class is rupee.
Of course, yeah.
For the first time, that realization has come that you're in a single asset class. Can I diversify my currency exposure? And therefore, you're seeing a lot more of international. So I'm saying that thinking or approach towards money management is actually changing.
Sure.
It's very different from the old traditional way that we had seen.
Yeah, so actually from a dollar wealth perspective,
right,
your wealth has gone nowhere even if it's doubled in the last 10 years, because the rupee is depreciated by...
It's appreciated, absolutely, absolutely.
Very interesting. Okay, I'll come to that. First, let me start with the broader question. Where is it that the millionaires are investing currently? Considering, and by currently I don't mean just in the last 1 month, but in the last 12 odd months, has the pattern of where the rich are investing changed?
Yes, yes. One of the biggest changes that we are seeing is that there is a serious allocation to the private markets.
Okay.
This was not the case earlier. Earlier, private markets was like, ठीक है, I'm doing some, angel and, some friend's family or, I'm just incubating some startups. But now you talk to 10 promoters and 9 out of 10 are doing this. It's not even 2 out of 10. Earlier, this was 1 out of 10. And it is not even size constraint. Earlier, only the very, very rich were doing that. Now, today, you meet a family office or an ultra HNI whose net worth, financial net worth is say 100 crores, or you meet somebody whose net worth is 5,000 crores. Both of them are investing. The size of checks may be different, but they are very actively. So one very, very clear trend that has happened, and they want to make direct investments. So one, they will do through funds, but they want to make direct investments. So like if you pick out, say, let me give you pick out an ACO. This is an insurance startup. Or you pick out, say, a Digit. We recently saw Nykaa, and Nykaa's when cap table came out just before the IPO, you see the list of HNIs which have been with the company from beginning. You see Policy Bazaar. So or you recently now say a Fab India is possibly going to come for an IPO. A lot of these have, they can count as family offices as their early investors. And a lot of these people have actually contributed, not only, just from a money point of view, but, being active board members, they've contributed on strategy. And I think that is where they enjoy it more. I think one is obviously, the money, and they are, making money. That is obviously their passion, and it's important. But also the fact that, these guys enjoy contributing, and it's their way of, contributing back to, some of these founders. So that is one big trend that we are seeing. The second, as I just mentioned a short while back, is international. This is non-existent. This has clearly gone as a trend that, gone up as a trend.
International stocks.
International stocks, international securities. When I say securities, people are investing in, basket of bonds. They are also investing in a basket of structured products. And not to sensationalize, but, SpaceX was raising money 6 months back, and you had Indian investors participate in that. You'll be surprised to know the Xiaomi IPO happened just pre-COVID, I think 6 or 9 months pre-COVID. And it was a very successful IPO in China. And you had HNIs from India participating in that. Now, I think that is where a lot of interest is coming in. And there is a lot of interest to, participate directly in stocks, but also through structured products. For HNIs, they play, you can do risk management through structured products. So that comes in. There has been talks about, obviously Indian bonds traded in dollars. They give a good, risk-adjusted return because you can also enhance the yield through leverage, etc. So a lot of options are opening up for people, and people are more receptive to that. Because people are saying, I want to have a certain allocation to international. I want certain money which is allocated in a different currency. Now, I'll not take too much risk with it. Some people will take more, but at least I want to invest it in a proper manner. That has clearly changed.
Interesting. Now, has that also changed in the recent turmoil? Because I think private markets gave a bit of a sign slightly earlier. Public markets are now in a bit of a downward spiral. Is the mood, behavior changing? And what is it that you are, therefore, telling them about their asset allocation?
So one is that I'll tell you.
So sorry, I want to know what the client is thinking, and then I want to know what you are thinking.
So I'll tell you what the client is thinking. I think the clients are reasonably smart. Let me put it that way. I never doubt that. And I genuinely think, I'm not saying this because I'm on a show and I'm saying it and they may be hearing, but they're smarter than us. They catch the trends also very early. So if you see, a lot of the clients actually identified the private markets trend very early. And if you see the data from November, December onwards to as recent as now, people were not very active in investing. They started pulling, I wouldn't say they started pulling money out, but they had made enough money. So they, maybe in some pockets, people booked profits, but they did not allocate new capital in the last 4 or 5 months at least. They have not allocated new capital. Now they are saying that let's start seeing opportunities.
Okay.
So they have been ahead of the curve. And I think there is, we would see some, I wouldn't call it the word panic, but if this, what we're seeing in the market and it continues for some more time, we will see some distress in pockets. And and it will be obvious, right? Because a lot of these companies that they have invested in, and if somebody's say invested in October and it's at X valuation, and a down round happens, if then the valuation will start showing a downtick. but I think these guys are seasoned. So it will have an impact, but they were very ahead of the curve. A lot of, so, and I'll also say this, and that is the difference between, say, an ultra HNI and a HNI. If you see, the HNIs continued to invest, a lot of these names, even in December, January, Feb, and when market was still going one way up, the bigger checks stopped coming.
Got it.
So, and I think that very well resonates with what we have been advising clients. So we were actually from October telling people that, private markets, we are seeing signs of, overheating. We do not want you to take, large or fresh positions in private markets right now. We felt that, they are overheated. And in fact, we also went underweight on small and mid caps a month ago, maybe a tad bit, just around the corner, around the correction time when it began. And we went underweight on that. We are underweight on equities right now.
You are underweight.
We are underweight on equities. So in our asset allocation models that we run, we are currently underweight equities. And that is actually, I wouldn't call it saved us, but it worked well for us. I wouldn't use the word saved, but it has worked well for us. And that is something that I think will be something that, we are looking forward, hopefully, that, this correction stabilizes at least. And then you can, start looking at redeploying. So currently, we're not saying that, buy the dip. We're not saying that.
You're not saying that.
We're not saying that right now.
Okay. What about fixed income? Is it a good time to buy with the yields where they are? I mean, are you suggesting to your clients to just go for that basic fixed income? No.
So we are continue to stay invested in fixed income, but our view has been that we do not want to buy duration right now. And we've not been buying duration for at least last 6 to 9 months because we expected rates to go up, and therefore we did not buy duration at all. And currently we want the rates to stabilize because there is a certain upside that rates will still have, but we are seeing a lot of pockets of opportunity. Like there are some fixed income ETFs which are yielding better than the tax-free bonds now on a post-tax basis, and ETFs underlying the security same as tax-free bonds. So we are trying to find these adjustments or arbitrages that are there in the market. So just to give you a sense on what I'm saying, if you look at NHAI or NTPC tax-free bond, that's trading around anything between 5 or 520 on a tax-free basis, and you have an ETF called the Bharat Bond ETF, which for similar maturity is trading at 750 upwards, and even if you do the taxation and indexation, you still have a 90 basis point to 100 basis point arbitrage. So this is what we are advising clients that if you're anyway holding it, do a switch.
Got it.
So that is an interesting pocket of opportunity. But if somebody will tell us, just go long on duration or buy the 10-year right now, we're not saying that because we see some more volatility in the rates right now. But what we've done, Neeraj, is that we've asked our clients to play a fixed income through a lot more innovative instruments which give better post-tax yields, because anything you do in fixed income, you just get charged the full taxation. Right. So REITs, InvITs, structured products, a lot of these ideas which give a better post-tax return and better liquidity. So we have tried to enhance client returns basis these things.
Okay, these structured products are restricted to a minimum size, or is it openly available? Just trying to understand.
No, they are openly available, but a lot of times the issuer, it depends on the issuer. You can have, you can have right from AAA to AA issuers. And the issuers sometimes restrict. So, if you go to some of the AAA issuers, they may restrict, minimum tickets as, 1 CR and all. But typically you can, there's no regulatory, like in AIF, there's a regulatory cap of, minimum of, 1 CR. In a structured product, there is no regulatory cap. It's a 10 lakh that you can issue. It's like an NCD. Okay. You can issue a 10 lakh structured product.
Okay. So, what about real estate? Are people receptive even now? Because I presume people were putting in money into real estate. Are they doing it now?
So last 1 year, we've seen a lot of activity in residential real estate and especially high-end real estate.
Okay, yeah.
So people have picked up a lot of self-use properties. People have picked up a lot of investment properties. We've had a lot of clients pick up, the high-end properties in Bombay specifically. And I think that is, we're not seeing the trend reversing right now because, real estate has also gone through a 10-year sort of lull with GST, demon, and various issues plaguing. The NBFC crisis happened, and but we are definitely seeing demand for real estate right now. We're not seeing a slowdown in any manner. It's not that we are seeing some massive slowdown. None of that is happening.
Okay.
People are buying.
Okay, nah, completely fine. So people are buying real estate, and which is something that comes out even now. One question which might be applicable to all investors is the answer that you gave me, that you are currently underweight equities. Now, is there, as a wealth outfit, I'm trying to figure out, are there events which will dictate when you change your stance? How do you decide the overweight underweight allocation? And also a follow up to that is that if you are underweight equities, or at the current juncture, what percentage of an ideal average client portfolio would you allocate to equities even now? What percentage would be to fixed income? What percentage could be to gold or some other things? What percentage could be to international? And what percentage would be to real estate?
So I'll share this allocation. So basically we run something called, and it's an internal term, but what we call is a Global Investment Advisory Committee.
Okay.
So what we've done is, because I'm a custodian of the client, so I, along with one of my colleagues, chair the committee. But we have built in all the expertise that Edelweiss has built over the years into this committee, and it's a very rigorous process. So we have our head of equities research, we have our head of wealth research, we have our CIO of the mutual fund for fixed income, we have our chief economist, we have our head of mid cap and small cap research. And then we have our CIO, we have our product head, and also it's as a fairly well diversified committee with different views. We meet on a very regular frequency, and if the markets are volatile as they are, then we meet on a short notice. Very interestingly, whatever the committee discusses and each person's views are published to clients.
Okay.
So I think this is an industry first. So, and the reason we did that is because I can say that may I just say, I told you right now that 3 months ago or 2 months ago we went underweight on small caps. Now it is a published thing and it has gone to the customers. So there is a lot of accountability that we put on this committee. It's not that I said this, market goes up to मैंने तो बोला था, and market goes down to I said this. It's not that. So it's a very serious committee. And this committee actually decides the core asset allocation. And so when we say that, we are 40 or 45% in equities, so currently we are 40% in equities. We are 40% in fixed income. And in the 40% in equities, we would be 85% in large caps and 15% in mid caps, no small cap exposure right now. And out of the 20%, it's actually 12 to 13% in gold and 7% in international equities right now. We are in fact, the committee met few days ago, and international for the timing we are bringing down to 5, and gold we are increasing much more. So equity we are not touching right now. Equity is at 40, we'll leave it at 40. Fixed income is at 40, we're leaving it at 40.
Okay. Final couple of questions. Sure. How receptive are clients to the advice that you give? Because these are guys who already created wealth, right?
Yes.
So in some fashion, they would believe that they know more than most people. So how receptive are clients generally to advice on wealth?
I think what they are very receptive to, and I think what has changed in the market again over the last 3-4 years is that with the coming of a lot of the newer generation, they are very receptive. They are actually, but also let me not generalize by saying they are very receptive. The fact of the matter is that a lot of these clients have also been used to just too many people chasing them.
Of course.
And so they have also become very cautious about who they talk to. They have become very discerning. And the fact of the matter is that they also see a lot of clutter. So unless somebody is bringing quality to them and quality advice, they are not going to deal with you. And clients also value a platform a lot. And one of the big differences, and I would like to highlight this here, is I think if you talked to me 5 years ago, the power of an individual was greater than the power of the platform. Today, the power of the platform is greater than the power of the individual. And I'll tell you what I mean. Today, for a larger client, he needs a multifaceted advice, and especially the ultra HNI or HNIs or family offices. They need to deal with your investment banking. They need to, because they will have in their companies, either they're acquiring businesses or they want to see a certain type of transactions. There's so many deals happening because they have become a semi-institutional set themselves.
Sure.
So if there's a pre-IPO round happening, or there is, a company is raising funds or they want to raise funds for their company, they want to be dealing with a platform which is able to give them this access. They want to be dealing with the institutional equities team. The reason, because with the size of the portfolios, they want to be also knowing, they want to know what is, a hedge fund thinking, how are the flows coming, what is Goldman Sachs dealing room thinking right now. I think these are nuances that, it's very difficult to provide as an individual.
Sure.
What does my fixed income CIO think about, RBI? Not what Alok thinks about RBI. They want to know what Alok thinks, but they also want to know what the fixed income specialist thinks. So I think the ability of the platform to deal with them is actually is what determines your access. And the ability of the platform to stitch all this together. I think the value today of the relationship manager is that how many of them are able to stitch this together, knowing what does the client need and able to stitch it. आपके पास सारी चीजें हैं. You have everything available, but can you talk to the client and present it to the client in the manner that he needs it? You have to put the client, you have to understand the client's need. Forget putting his need first. That you have to do. But unless you're able to understand the client and you have that nuance that what does he need, like one of our clients is looking to set up a new business for his son. Now, he has a very specific need that he wants to acquire a company in building material space. Now, can we get our M&A team to show him 10 companies over the next 3 months? Or can we go to 5 other, places and get him that? Now, if you can do that for him, his investments is automatically coming to you. But having said that, you have to do a very good job on the investments as well. So I'm not undermining that, but I'm saying there is a overall platform that the client needs to deal with. It's not an individual anymore. The individual has to stitch together the platform for him.
Got it. Okay. Final word, Alok. Any piece of advice for people who are not necessarily the clients? I presume you mentioned that you cater to people with a minimum AUM of $5 million, so which is a 35 crore, 40 crore net bracket. Any advice for people who don't quite have that kind of wealth, but are trying to get into the minds of people who advise the rich or the rich themselves?
No, I would just say that, and that's what we tell all our clients. We want to keep things very simple. I think people like us complicate the investment world and, the investment thing, they make it look very complicated because we want to look important. But I think getting your asset allocation, and more than asset allocation is a very heavy word. Can you get your thinking right? What do you want to do with this money? And it's very basic, right? I need the money for buying a new house. I need the money for my son's education or daughter's education. I need the money for my retirement planning. Whatever it is, you need to create a corpus or that. Can you start with that as a journey? And start planning, and you understand your risk appetite. I think understanding of your own risk appetite. Like today, if you're a long-term equity investor and you're seeing red on your portfolio every day, are you really bothered? Or you don't see your bank FD every day, right? And I tell this to everybody. And I started with my mother, that when I made her invest in equity markets, and I said, do you look at your bank FD every day? Do you call up the bank and say, okay, now what is the accrued interest on this?
Sure.
You don't ask them, right? Then why do you want to see your stock every day? It is doing what it is. The company is not stopping work because the stock price is down. So if you are long term and really long term, then behave long term.
Okay.
So I think it's a game of patience. There is no quick money in this business. People who are saying that there is quick money are lying. And people who are thinking they'll make quick money are in for some trouble. That's all I'll say.
Okay. Well, Alok, that was the beginning of this answer was a fairly self-depreciating and a modest comment. So thank you. But more importantly, thank you for joining us and giving us a sense of how do your clients who are the uber rich of India and how do you who advise those guys think about everything related to investing.
Well, thank you, Neeraj. My pleasure entirely. And I thoroughly enjoyed this conversation.
Yeah, likewise. And I'm sure all our viewers are going to enjoy this too. Well, everybody, thank you so much for tuning in to this inaugural episode of Where Do Millionaires Invest?